Hello, my name is Kevin Apple and I'm the chairman of Avondale Corporate. Today I'm going to be talking you through a short guide on employee ownership trusts and why they might be suitable as an exit strategy for your business. Avondale have been selling quality private companies for nearly 30 years. EOTs account for some 20% of our practice, and in fact today they're nearly 10% of business sales. However, they're poorly understood and implemented in many cases. Yet they're an amazing way to maximize shareholder value, create an exit strategy, and build a legacy, all at just 12% capital gains tax. They're also part of purposeful capitalism. How do you create a long-term business model driven by the employees, locally investing? So we need to understand why EOTs may just be your alternative business sale, an alternative to private equity or a trade deal. We need to examine what they are, the business operating model, how you technically transfer into employee ownership trust, and why it might be right for your business, but also why employee ownership trust is part of purposeful capitalism, that long-term business model. There are some 3,000 EOTs in the UK, with about 350 companies selling into employee ownership trust each year. So it's an important exit strategy that you need to be aware of when considering succession and your potential business sale. So what are employee ownership trusts? Well, they are a long-term operating business model with notable examples, John Lewis and Richard Sounds. John Lewis is over 100 years old, employee owned. Avondale, I'm proud to say, are also employee owned. Transactions are typically completed at up to full market value and are subject to capital gains tax of just 12%, very attractive compared to the 24% that trade or private equity sales have. The EOT process is both vendor and advisor led, but it must be independently checked by a professional trustee for both affordability and reasonableness. A new company is established. This is usually a company limited by guarantee, which is an entity normally used by charities, so it doesn't have shares and does not trade. That new company buys the old company on behalf of all the employees, who become beneficiaries of the trust. So long as 100% sale is carried out, there are normally no direct shareholders. The acquisition is funded through spare cash that may be available at completion and a deferred consideration. To maximise value, often the period is between 6 to 8 years, which would align with the full market sale value, but also the company's cash flow to ensure that the acquisition is affordable in deferred consideration. As EOT resales are rare, as I mentioned, there's some 3,000 in the UK, but very, very few have changed hands. It's probably better to think of EOTs as selling into a mutual business model rather than seeing them as conventional employee share schemes. So, how do we structure employee ownership trusts? Well, typically we will sell 100%. And that's because what's known as the hybrid model, where you sell less but more than 50%, is increasing the probability that the trust will have to carry out another transaction on behalf of all the employees. And the capital gains tax saving is a one-off. And so the 12% tax is only available on the first transaction. Thereafter, any future sale will be at full capital gains tax, now 24%, but in the future could be as high as 40%, the same as income tax. So many sellers adopt to choose for 100% sale to also keep things simple in change management for the employees. We are owned by the employees for the benefit of the employees is a much better story. The price is set at up to full market value, but it's critical it must be affordable and independently valued by a company like Avondale. The trustee must be involved in that valuation and confirm valuation and structure and the independent reasonableness of that valuation. Management are usually aligned to the sale because they have to work to achieve the deferred consideration over a period of time. This is normally done by reward and pay structures, alongside all employees receiving tax-free bonuses. The management board is the operating board for the company. They run the business. Think school headmaster. The trust, although it owns the company, is non-operational. Think school governor. If the business being run for the benefit of the employees. The trust board can never be controlled by the sellers. That's critical and mandatory under the legislation to ensure that a full change of control occurs, but also to avoid contrived structures. So it's also critical to trust control ultimately the business's cash flow and deferred consideration. So although deferred consideration is due, it is subject to cash flow and it's subject to the trustee's assessment of affordability, albeit it is contractual and therefore sellers can rely on it, subject to the success of the business. So why might you consider employee ownership trust? Well, they're a great exit strategy and succession that reward your employees as well as create a legacy and hopefully long-term invest more locally and deal with your succession. Employees become beneficiaries, not direct owners typically, which makes EOTs far simpler to administer than traditional share schemes. The administration is much more like a pension scheme, with all employees benefiting from up to $3,600 a year tax-free per employee. This must be paid equally, but the great benefit for all employees is improved retention, responsibility and reward. We normally evolve the 3,600 after transition. We don't start at that level, but we look to grow it as a motivator. But tax-free is a big difference to many, many employees. After handover, the professional managers run the business, perhaps with the sellers involved handing over to the professional managers. But remember, the sellers cannot control the trust. The trust is there to make sure that the business is run for the benefit of the employees. So more fiduciary than operational. The operational is in the main company board. And often EOTs in fact become more commercial, not less. They're not a transparent business model. Management will need to have more information than the traditional owner-manager business, but not all employees are privy to all decisions, and nor do they see all the data for the business. The main company board is where the action is, and that works symbiotically with the trust. The process of a sale is pretty quick. Most of our EOTs are carried out within 3 to 4 months, subject to HMRC tax clearance, which is allowed and mandatory up to 30 days. They're fast, so there's no third-party buyer, although, as I've mentioned, the trust must check that the structure is correct and that the valuation is independent and reasonable. EOTs are part of purposeful capitalism, redistributing wealth and investment. The long-term goal is a team-driven business model that carries on locally. There are very few EOT resales, and that reflects that the tax has just rolled to the trust, so tax on resales is expensive, but also culturally EOTs don't really suit many commercial buyers. So EOTs have a significant tax advantage at just 12% versus 24% for trade or private equity. But as most EOTs are paid for over a period of time through deferred consideration, that capital gains tax is due on completion. HMRC have confirmed that under Section S280, you can apply in your self-assessment to stagger that tax, typically for up to 8 years. However, it must account for a minimum of 50% of each deferred consideration. In reality, what that means is that the tax is normally front-loaded over the first 2 to 3 years. However, it's still the best tax rate in town. It's important the trustees are involved in the independent valuation. It's also important that that independent valuation is carried out on an arm's length basis by an advisor like Avondale. We'll be looking closely at both HMRC approval against other price earnings comparable multiples for your sector, but also balancing what's right in affordability for the sellers, the trust, and the employees. There is a second tax break with EOTs, of course. You could have aimed at a team-driven business model and kept your business, not selling it. But if a deferred consideration, typically as I've mentioned, is over 6 to 8 years, in reality, you're moving income into capital over that period. So you could have taken dividends similar to the deferred consideration, albeit they would not have been contractually due, nor would you have dealt with your succession. If you had taken dividends, you would typically be paying tax between 35 and 50%. So with EOTs, there's a second significant tax advantage, not just the 12% capital gains tax, but also the tax you would save on income over the 6 to 8 years as the structure is paying for itself. If you do that over 6 to 8 years, you'll almost double your money on just putting the business under management, making EOTs very attractive for sellers seeking an exit strategy. So let's look at an example. We have John and Nigel. They run a joinery business in the retail sector. They're both over 60 years old. They've tried a trade sale and failed, but they've got over 80 members of staff. None of their family are interested in taking over the business, although several nieces and nephews work in the company. How do we structure it? Well, Nigel and John had managed to build up significant spare cash, which was paid to them at completion at 0% tax rather than at dividend rates. The rest paid over 7 years, typically with interest, although we asked them to waiver some of the interest in the first instance to get the capital down. The interest creates an instrument to motivate the trust to pay on behalf of the sellers. And a price earnings ratio of nearly 4 was achieved. The management were promoted and the team given an incentive package so that once deferred consideration was achieved, they got additional rewards and bonuses. For simplicity, 100% sale was carried out and tax was at just 12% with full HMRC approval achieved. So, in summary, the EOT advantage. Well, first of all, I do want to say there are in fact some disadvantages. The disadvantage, of course, with an EOT over a trade or private equity sale is present value of money, as most EOTs are financed on the deferred consideration. And that means sellers are taking the credit risk. However, for those sellers, often those who want to stay involved or those who do not have high price earnings multiples in their sector, or many deals in their sector have high earnouts, an EOT is better as it's effectively an earn-out with yourself. So EOTs really suit where perhaps third-party trade deals may be difficult. Many EOTs, however, are, as we've mentioned, poorly implemented, and that's usually around where the EOT is carried out at a maximum plausible value, but no consideration is given to how to align the employees and in particular the next generation, the management and the board who are going to take over to the EOT structure. And because of that, they're also poorly communicated from a change management perspective. We believe that an advisor that's looking after both financial, and we call it the 4 corners of EOTs, so that's financial with tax clearance and confirming an affordability and credit risk model, legal, and the professional trustees involved, and then fourth, the strategy. How well is the EOT business model communicated and alignment created to the deferred consideration in the existing team so everybody understands what they've signed up to and how the EOT is a long-term business model and not necessarily a share scheme. As I've also mentioned, EOTs are now some 10% of business sales, and that is because they are fast and advisor-led processes. So EOTs are not as complex as many advisors may represent. The complexity is in the how, but in reality, EOTs are better implemented when we look at why. Why they may invest more locally, why they're more productive, why as an exit strategy they enable you as a seller perhaps to stay involved and hand over a period of time, and why that may be better for all your employees and management than a trade sale, as incentives are aligned alongside it. And ultimately, why EOTs may be better, purposeful capitalism. How can we create a team-driven business model that invests more locally, rewards employees more locally, and invests in the long term for your succession? Thank you for listening.